Joining me on what's driving or what had driven that advance and where they're headed next is Larry Shover. He is Chief Investment Officer at SFG Alternatives and joins me now from the CME. Larry, a bit surprising given that the euro-dollar pair in the cash market is at about a two-week high of $1.35. We look at the strength in euro-dollar futures. I'm surprised given that the ECB has room to cut interest rates.
I do too, but right now it seems like the euro is quite content to grind higher, and for some good and fitting reasons. I mean, people are very, very comfortable with the low rates in euro and the euro-denominated bonds right now. Also, when you look at the U.S. dollar interest rate curve, that's creating a huge headwind for the U.S. dollar. So, lastly, you have ECB. Let's face it, they're fighting the Fed right now. I mean, they don't like this appreciation of the euro, but will Draghi be able to do anything about it? We don't know. I would suggest that we should get short the euro, maybe not today, but really soon. I mean, when you consider the fact that U.S. has superior growth over Europe and the fact that our dovish-nes is very, very small compared to what potentially could happen in Europe, I do think it's just very overbought, time to get short.
Gotcha. Now, I know you say that right now what we're seeing is more a case of dollar weakness as opposed to euro strength. Is that going to be the same dynamic in the coming weeks and months?
You know, I think so, but less and less. I mean, right now, clearly the interest rate differentials is the headwind for the U.S. dollar. But when you look at Europe, that they've had 6 consecutive contractions with 1 not contraction. There's potential deflation in the periphery with inflation targets at the core well below their levels. When you measure all that in, you have to think that the dovish-nes in Europe is going to be much bigger than our dovish-nes, and interest rate differentials will be secondary.
What is it going to look like in March when the Federal Reserve is at least widely anticipated to begin talking about tapering?
Yeah, I think the markets, you know, at least the FX markets, the interest rate curve in the U.S. has really factored that all in. And if anything, I think the 10-year yield might be a little higher than it will be when they start tapering, because we are recovering. We're taking baby steps. A little bit of drama is built into the 10-year curve right now, but I don't think that we're going to be much higher than we are today.
Larry Shover of SFG Alternatives with today's Futures in Focus.